Hi, it's John Kelly. In this module, we are going to discuss professional ethics, particularly Rule 200 about public protection, except that I'm going to leave Rule 204 to another couple of modules because it's a long rule. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. And we're going to find that there are some items that the professional ethics rule require documentation of or can be dealt with by documentation, and I'll point these out as we go along. Rule 201 is about maintaining the reputation of the profession, and it says we should act with courtesy and respect at all times and in the public interest at all times. And that we're going to find is a theme throughout these rules, that as a professional, you act in the public interest over your self-interest. Now, I think for the long term, acting in the public interest will in fact be in your self-interest. In the short term, if you put your self-interest over the public interest, you're almost guaranteed to get into trouble, regardless of the rules. You'll get into trouble with the rules, but you'll get into more trouble with other stuff. So acting in the public interest at all times, really important, and a theme of the rules. 2012, rebuttable presumption of guilt if you've done illegal stuff, and the same in 2013. Guidance to 201, we should take care if we criticize other people. And that again is just good advice. If you think you are required to criticize another, particularly another professional, read the details of the rule and maybe even see a lawyer before you go ahead and say something critical of another person. Guidance on resignation. It's important to remember here, as auditor, you have a duty to report to the shareholders. So unless you have reported to the shareholders, you really shouldn't resign. And the only people that can fire you or request that you resign are the shareholders at an annual meeting or at a specially called meeting. So the rules say you should never, in quotes, lightly resign. Perhaps you might even see a lawyer to talk about it. The only way you can resign is if you have a good reason. You've lost trust in the client, you've lost independence, or the client has asked you to do something untoward. In those cases, you can resign. All of those are something that you might want to tell a successor. 1 and 2, or 1 and 3, you would just say there are professional reasons. Number 2, you might advise the successor that, yeah, you had an independence problem and accordingly you resigned, but nothing else is going on. If you have a situation where the board or a management comes to you and says, hey, we want to replace you with somebody else, please resign, you should probably say no. They can fire you if they want. They can take the responsibility to the shareholders that they replaced you and not the shareholders, but you don't want to assume that responsibility yourself. And certainly, if there's anything that you should have reported to the shareholders and you resign without doing that, you could potentially be criticized by the shareholders. So if you're in this situation, read these rules carefully and never lightly resign. Acting with integrity and due care at all times, obvious. Be careful not to allow your judgment to become impaired. This notes that this applies if you are acting as a volunteer. If you're a volunteer board member, or if you're volunteering in some other capacity, you have to continue to act professionally. Points out the fiduciary duty of an employee, for instance, to an employer. And again says that public interest overrides self-interest. We're going to see that more than once in these rules. Guidance, be careful if you're an advocate. There are more rules later and we'll talk about it, but basically, if you're asked to state the facts, if you're asked to state how a decision was reached. You can do that. But you're not going to act like a lawyer who will defend a client whether guilty or innocent, and that's the advocacy role that's allowed for a lawyer, but not for us. Be careful with independence and conflicts, and there's more rules about that later. And of course, always watch threats to your objectivity and integrity. Objectivity versus independence, and this is a subtle but important point. Objectivity in the rules, and this is defined in the rules. This is not necessarily what these words mean in the dictionary. Perhaps in the dictionary, objectivity and independence mean the same thing. But the way they use them in the rules is say, okay, objectivity is a state of mind. And perhaps you could be objective but have a significant financial interest in a client, but you are very, very objective, and perhaps that's possible. And what the rules say is, okay, we understand that maybe that could happen, but what we are going to require is independence, and independence is what a reasonable observer might decide. And the code makes calls on when constraints would cause a reasonable observer to think that you're not independent. So, for instance, if you say, well, I can be objective if I have a financial interest, the rules say, well, okay, we thought about that, and we do not believe that a reasonable observer would think that, so you're not independent, even though you might be able to argue that you were objective. So they're drawing a line. There are things you cannot do because they have concluded that a reasonable observer would say, no, that's an independence threat. And for instance, valuations. If you are doing the audit, you cannot also do a valuation. And maybe you could be objective and maybe you couldn't, but the point is the rules say, well, a reasonable observer would conclude that you shouldn't do both. So that's the rule. Follow it. 203, sustain professional competence, do professional development, of course. Don't make any false or misleading statements. That includes plagiarism, academic dishonesty. This applies to members in public practice and members not in public practice. So don't make any or be associated with any false or misleading statements. And comply with all the standards. That, of course, applies to GAAP. Whatever the appropriate reporting framework is, it applies to GAS. It also applies to other standards. If you're a business valuator and there are business valuation standards, you've got to comply with those. And the rule applies to management, board, audit committee. If you're a professional and you're in management or you're on the board or you're on audit committee, you have to make sure that the organization you're with follows the standards. And there's guidance in paragraph 14 for the audit committee. You're required to use judgment. You're required to document. If you had some issues with what the correct way to follow the standards was, you would document it. And then they talk about disagreements. And I just want to highlight, there's a difference between a discussion and a disagreement. If one of your business partners comes into your office and says, hey, I'm trying to figure out what we should do in this situation. I think maybe we should do this. And you say, oh no, I think maybe we should do that. And you both put your heads down and read professional standards and talk about it. And in the end, you conclude, oh, you were right or I was right, or perhaps the third position is correct. That's a discussion. That's not a disagreement because you, in the end, mutually resolve that you come to the correct answer. That can apply with a client as well, that they want to do it this way. You say, no, you should do it that way. You talk about it, and you both conclude that you're okay. A disagreement's different. Disagreement is you think one thing, absolutely, that there's no way it can be done any way other than this. And the client completely disagrees. Well, there are processes to be followed. Firms have to have dispute resolution policies and practices. Read the rules, follow those rules. Too detailed for this discussion. 207, you're not allowed to have unauthorized benefits. That's pretty clear. 208, confidentiality. Don't disclose confidential information. Don't use confidential information. Maintain and protect information. And you have to have a written agreement with staff, perhaps part of the annual independence confirmation, that they will hold client information in confidence. You might just want to include all staff and all partners. 208, you have to have security over information, electronic security over electronic information, physical security over physical information. And one of the ways, of course, that you can maintain security, physical security over physical information is after an appropriate period of time to destroy it. Then no one can get at it. So you need to think about when you should be destroying certain information. You have to advise clients of the methods you use, and perhaps you'd like to have a paragraph in your engagement letter saying, we maintain electronic and physical security measures. The other question is, lots of times clients will send you records, either physical or electronic. You need to think about how long it is before you destroy those or return those. So if the client sends you their general ledger electronically, you might decide that, after 6 months, we're destroying all that. Or some period of time, we're destroying that. They have a copy. We don't need to keep a copy. The other question you might have is, when do we destroy audit files? How long do we wait? We'll talk about more of this under 218 about retention, but maybe you would tell clients, after 10 years, don't know the right answer, we are going to destroy the audit files. So if you're relying on us to retain your records and be a records retention backup facility, no, we're not. We keep our audit files to protect us. We do not retain your records. We give them back or destroy them. Loans. You cannot borrow from clients unless perhaps the client is a bank, and that's what they do. And if you do have a loan from a client, it has to be under normal terms and conditions. You can borrow from family, but of course this rule is easiest to follow by not having any kind of a loan from a client. If you do have a loan from a client, read the rule. And the rule does not apply to business ventures with non-clients, to prepaid fees, or loans to employees. The rules on loans apply. This applies if the client giving you a loan has been a client in the previous 2 years. So if less than 2 years ago, the client was an audit client, you can't get a loan from them. And of course, it's best that this is all in writing. If you have a loan from a client and the terms and conditions are not in writing, it's going to be very difficult perhaps to establish that they were normal terms and conditions. Conflicts of interest. Consider any conflict of interest that it might generate if you accept a new client before you accept the client. And to remind yourself, that might be something that you would put in your acceptance checklist. I've thought about conflicts and there are none. If there are conflicts, you can't take the client. There are conflict management rules and rules on documentation. In a small firm, I think this is probably going to be pretty simple. As the size of the firm increases, as you have a middle-sized firm with network firms, or in a big firm, there are more complicated rules because there are just inevitable conflicts. And they talk about firewalls and cones of silence and other stuff like that. So if you're in a big firm, this is going to be taken care of for you. If it's in a small firm, you're probably just going to deal with this by not taking a client if it would result in a conflict with other clients. Probably not much you can do given the small size of the firm. 211, 12, and 13, report breaches of the rules. Be careful when you're handling property for others, of course. And no unlawful activity. I think that's the third time the rules say you can't break the law. Fee quotes. Before you give a fee quote, you should get adequate information. You should render billings fairly and explain why. And no lowballing of fees. That's what the rule effectively says. Lowballing, I think, is a bad idea for a variety of reasons. If you figure you're going to get a client by quoting a really low fee and then raising the fee later, you're probably going to annoy the client. Or you're going to get a reputation for giving really, really low fees, and people will come to you only for a low fee, and you won't make any money. So one way or another, probably before you run into trouble with the rules, you're going to run into trouble if you lowball fees. No contingent fees. Simplest way to deal with that is not to have any contingent fees. There are some exceptions. Simplest just not to have contingent fees. And no commissions other than in the sale or purchase of a firm. You can't pay them. You can't receive them. You may pay commissions to employees, but other commissions, let everybody know, don't have commissions. And secret commissions are against the criminal code in Canada, and you can go to jail for that. So be very, very careful with commissions. Simplest, don't pay them, don't receive them. And again, you're going to be in much more trouble if you're doing secret stuff with commissions, because you can go to jail, not just get in trouble with the code of ethics. So be very careful with that. Advertising, of course, if you advertise, be professional. And again, great care in soliciting new work and great care with endorsements. You wish to establish a reputation that you are professional. So going around and soliciting new work in an unprofessional way is going to get you into trouble, and probably in the long term is going to mean you're not going to get work. So be very careful with that. Records retention, we talked about that for a bit. 218 requires that you keep records for a reasonable period of time. It says it depends on the nature of the records, but does not give you any guidance as to how long you need to retain it for. In Canada, for the Tax Act, most records only need to be kept for 6 years, so there's one stake in the ground. One of the things you might do with clients, now you retaining your audit file, that you keep your audit file so that you can defend yourself if the client seeks to argue that you didn't do the audit properly. You will produce your audit file and say, here's my audit file, I did it properly. If you have an engagement letter paragraph limiting your liability to, say, 2 years, then you would want to keep your audit files for at least 2 years, after which the client can't sue you, and you don't need your audit file anymore. Again, documentation, perhaps you're going to have an engagement letter paragraph saying we keep our audit files for so many years, and then the client knows. And also emphasize that we are not a records retention service. If your client expects 15 years later to be able to phone you up and say, I need a copy of the bank confirmation from 15 years ago, you're going to go, you know, we told you that we threw our audit files out after 10 years, so we don't have it anymore. And the client won't expect to refer to you if they're trying to find copies of their records. The client should keep their own records. So, as I said before, you should read, understand, and follow the rules. A lot of this, I think, should be obvious. Some of the stuff about where the people that set these rules have made determinations about what a reasonable observer might think is not appropriate. You think it is appropriate. It's been concluded that it's not appropriate. You need to kind of be aware of that stuff, but most of it, I think, should be obvious. And as I said, trying to find ways around the rules generally is just a bad idea. And if you say, you know, the rules tell me how to act like a professional, how do I get around that? That's a bad idea. So thanks for listening.